welcome to this week's edition of Taking Stock. This is a show where we try and recap all that went through in the week gone by, and we give you some cues to watch out for in the week to come. I'm Sonia Shenoy, and with me is Ekta Batra. Well, it's been a very interesting week for the markets. This was a truncated week, but a week in which we had the most important cue, which was the Reserve Bank cutting the interest rates by 50 basis points. Of course, the market did not move too much through the week, but what it did do was put a floor at that 7,600 level, a level that we had hit a couple of weeks ago. Also, the Nifty managed to hold on to 79.50, and we saw a lot of interesting pockets like pharma, etc., spike up in trade this week. But what about the weeks to come, and what's the outlook from here on? Vinay Khattar of Edelweiss joins in now to give us his view on all of the triggers that have gone by. Vinay, hi, thanks for joining us on the show. The RBI policy has come and gone, and the market has taken it well. But what do you see as the trajectory for the market here on?
Hi Sonia. The broad sense is that once the RBI cut, which was very heavily anticipated, that's happened, and very quickly we saw banks transmitting that rate cuts, with number of banks taking cuts in the region of about 30 to 40 bips in terms of their lending rates and so on. So it just adds up to the economic traction which has been building up on the domestic side, and which has been the key positive, the key hypothesis for a lot of us, that the overall macroeconomic situation within India remains comfortable and is showing traction, especially with pickup on the infra and construction side. However, the pressure would emanate from the international side, if at all, and that causes the market to trade in a kind of a range with maybe some degree of downward bias. International money flow has been one of the key pain points. Just to give a sense to your viewers, sovereign wealth funds constitute a very, very large part of international fund flows into equity and debt markets. Total sovereign wealth fund market is about $7.5 trillion, out of which almost 50% plus is from countries which are hydrocarbon producing or exporting countries. Now, with price of oil crashing so dramatically, this very, very large pool of money is under a lot of stress, and that is causing pressures to build up in most of the equity markets across the world, and specifically getting reflected in emerging markets. So at some level it appears that 7,500 is a bottom given the overall domestic macro scenario. But the international fund flows will continue to have an overhang in terms of market moving upward. Okay.
Vinay, we're going to get into earnings season next week on. We have Mindtree on the 8th, and we have IndusInd Bank also releasing numbers on the 9th. Your sense in terms of what we can expect from this quarter, and which sector might stand out on the upside as well as on the downside?
Sector is expected to be muted. We've seen that the demand recovery has not happened as what a lot of people would have expected. Certain degree of downgrades would probably happen even in this quarter. And if you would just to look at results of the last quarter, we actually degrew in terms of bottom line. Top line was also some degree of muted growth. Most of these trends are likely to continue in the coming quarter. That means the top line for companies on an average would have a muted kind of a growth, and the bottom line would be flat to slightly negative. Now, if you look at, this is a very generic one for the overall basket. There will be areas which will shine. There will be sectors which will do well, which could include the urban consumption side, which is on the FMCG side. You could have autos, especially the MHCV players like Ashok Leyland deliver a good set of numbers, and maybe even in terms of rural demand, especially on the housing side, stocks like GRU and Repco could be interesting bets. Now, the sectors which will do well are where you will see at least early signs of demand pickup. Let's say in case of consumer durables, you are seeing data which is turning positive after many, many quarters and many months of negativity. The consumer durable demand has turned positive. Government is taking a lot of action in terms of road construction space. Last year we bid out about 3,300 kilometers of road. We have already done 2,400 kilometers, which is about 70-75% of the last year, already in first 6 months itself. So road construction, EPC companies, BOT companies, they could provide a lot of positive surprises in this particular quarter.
Okay, that's an interesting observation. But Vinay, what do you do with a stock like HCL Tech now? I mean, you know, this stock has been one of the best performers this year, but now there's a client-specific issue because of which it got hit hard. Do you keep the faith and either accumulate or stay with the stock, or now do you start to become a bit cautious?
So our sense is that that the degree of overvaluation or a stretch valuation which was there in HCL Tech, that has gone away with a very steep correction which has happened. If you were to look at what company reported, a $20 million hit in terms of specific client issue. Plus, the big concern which market has been surprised with is that one of their core components of the business, which is the IMS part of their business, infrastructure management services, which gives them almost 35% of their revenue, one-third of their revenue, they are facing some challenging situation there. And what is happening at the global level is that a lot of companies like HCL Tech, which were handling infrastructure management services for the companies in US and Europe, they were still handling infrastructure which was at a relatively basic level. Now, as these companies in US and Europe are moving towards cloud computing and so on and so forth, the competence required to manage infrastructure for these companies would go up. The complexity would go up, and that's a transition which market is worrying about as far as HCL Tech is concerned. So maybe for a quarter or two, market will see what are the kind of numbers that the company report, how is the company able to handle this IMS challenge going forward, and then you could see upside on the stock. Our sense is for the near term, the stock could remain range bound with maybe slight upward push in case any positive news emerges.
Okay. Vinay, how would you approach Titan? There were two cautious notes which came out from your peer brokerages, and there's an estimate that the jewelry business may decline in Q2. How are your thoughts placed on Titan?
So my broad sense as far as the jewelry business and Titan is concerned is, if you were to look at what's happened for last 10 years in case of gold and jewelry demand, gold has always been India's one of the favorite places to put money in. But with very high degree of inflation, the physical assets in India grew dramatically, and gold was a very big chunk of it. And significant of demand or appetite for gold led to jewelry demand. Now, with inflation being very low and financials doing well, the household saving will shift from physical assets, which is real estate and gold, towards financial savings, which means that the demand for gold anyway should begin to taper off to a certain extent. It may not be as aggressive as what we saw in last 5, 7, 10 years. That is one factor. But overall, the slowdown in the gold, in the urban consumption and the domestic and the rural consumption could be the second factor which could cause the demand for jewelry to taper down. And that's my broad sense at this particular juncture.
Okay. You know, the other big issue that blew up in the last 1 week was this entire Volkswagen scam. And we saw a lot of companies getting impacted by it. Motherson Sumi was one of them. There was sentiment impact on Tata Motors as well. What do you do with these two stocks now?
So, I mean, world has been riveted to the TV screens in terms of what's gone wrong with Volkswagen. 11 million cars being impacted with the software glitch, which will cause the nitrous oxide levels to be misreported. Now, it's a clear case where company has made a mistake. It's a clear error, and I think there could be penalties, including the criminal liabilities which could emanate out of US. Now, globally, you will find that a hit of such a large scale is not very, very common, and that is what is reflected in the stock price. Now, our sense is that the Volkswagen itself is sitting on a huge amount of cash, almost $30 billion. Plus, it generates operating cash of about $10 billion every year, which is a very, very large sum. So, will the company be able to take the knock and move on? Our sense is yes, though the criminal liabilities or the class action suits could have significant impact in terms of this cash reserves. But how does the consumer in Western countries behave in terms of their actual demand for diesel cars? And what could be the impact on market share of Volkswagen, both in Europe as well as in US, is going to be the key question. And that is one answer that we'll have to wait for, because I don't think even Volkswagen or Audi has a sense today what will play out. That leads us to the companies which are the auto ancillary suppliers to these companies. Motherson Sumi has been one of the key auto ancillary suppliers. It's been our favorite for last 2 or 3 years. We've liked the stock very much at about 100 rupees or 95 rupees, and it's been our top buy. But our sense is that with what's playing out in Volkswagen, there are near-term headwinds, some of which has already got factored into the price over last month or so, and maybe in the near term the stocks will stay at these levels and wait for more information that could emanate out of the data in Western markets in terms of demands for both Volkswagen as well as Audi cars. If the demand shows no disturbance and demand continues to remain robust and picks up, I think Motherson Sumi could be again a very interesting bet going forward.
Okay. All right, Vinay, we leave it on that note. Thank you very much for joining in and giving us all your fundamental thoughts. We'll take a break now, but as we do that, let's get you some market opinion we've heard through the week.
Markets, we should see in the context of global markets, because Asian markets and global markets have been very weak. So, but for this pleasant surprise or a very decisive cut in the rate, I think markets would have been, and as you know, that before the policy announcement, markets were significantly lower. So markets will continue to be guided by global factors, but within that, if you take a medium to long-term view, then I think India has a great opportunity to turn around. So I think he has taken the rational decision to do the rate cut by 50 basis points, and maybe a 25 basis point probably would not have been good enough for two things. For the market is one, but more importantly, even for transmission by banks, because they are still reeling under NPA and cost.
So now if you look at Nifty 50 EPS numbers, we are somewhere about 535. My sense is this will get cut about 5-6%. So then you are looking at somewhere about low 500 kind of a number. And given the mood as far as emerging markets are concerned, I can't make a case for 17-18 kind of a multiple now. I think we'll have to more live with maybe 15 kind of a multiple, 15-16. In which case this market is looking very fairly valued as far as March 17 numbers are concerned.
Around those levels, the market again gets back into an attractive risk-reward zone. And especially in the context of our 8200 Nifty target for December. So yes, that area, that zone would be definitely attractive. Price-wise correction in our view can happen if we continue to see a meltdown in emerging markets in China, etc., which drives further selling in India, because you have to remember that investors continue to be very, very overweight India. So if you look at their overweight position on India, it's comparable to historical highs as far as India is concerned. So for them, if they keep seeing redemptions, they will be forced to sell India. And fundamentally, if you look at the downside, 75-77 is what makes the markets reasonably attractive.